looks like we're of the hour. I'd like to welcome everyone to our Q1 2022 Multifamily Investor Forum. We're really excited to speak with everyone today. And first thing I'd like to announce is the release of our latest research that accompanies this presentation on transaction last year, 5 units up in the apartment space, which is 383 transactions we track and research, as well as data on rent, vacancy, and apartment sales for the last 15 years. So look for that in your inboxes on Friday, and please follow up with any questions you have on that research report. Next, what I'd like to do is introduce our team. Want to really thank my business partner, Jared Anderson, for supporting these efforts for all of our research and these presentations, as well as my partners, other brokers in our business, Matt Laird, Brandon Lawler, and Winslow Lee. And also for those of you that have not been in close touch with us, we started our Eastern Washington presence with Max Frame joining us last year. So really excited to have all 6 partners in the business and really excited to have them support us in the research and the presentation we're giving today. If you do have any questions on any of this, please feel free to reach out to any of us. Next up, quick year in review. 2021 was a terrific year in our business. We had 43 transactions closed last year. What they consisted of is in 5 different counties, a lot of transactions in King County. We counted 31 apartment sales, just under 2,000 units sold, 12 development sites, as well as about 500,000 square feet in development site apartment land we sold last year in 13 cities across 5 counties. You'll see Yakima and Spokane markets, what Max is pushed into, and we're working in several other Eastern Washington counties as well. As far as our plans this year, we're off to a fast start. Our goal this year is 51 or 52 closed transactions, which is 1 a week, and we're on track so far. Currently, we have about 39 transactions in our queue, smallest being about 1.1 million, largest 70 million. About half so far are active apartment buildings, the other are development sites. So moving on to our research. For those of you that did not spend time with us in the last quarter of last year, we revamped all of our research. So we have a completely new format for our research. All of this is available at simonandersonteam.com/research. We'll have our new research report uploaded on Friday. Take a look at it there. Highlighting how we've changed our research. Key changes, first up, is frequency. We're now releasing our research every single quarter. And so we just want to be able to provide investors a more granular look into the market, more frequent updates. Next is content, covers sales, rental rates, and vacancy. As far as the data, so far it covers the 4 Western Washington counties for apartment buildings 5 units and up. And the analysis, the big change that we did from previous years is we're now doing 90-day for quarter over quarter and 12-month for year-over-year trended data. The market's moving quickly. We want to help our clients track the market more closely. So we've changed up how we've done our tracking, but we're also going back 15 years for data. So we can look at a lot of trended data, but we're really starting to look at is what's been happening more recently in the market. We do still provide special research reports. So in the spring, we'll put out our development pipeline report, and the fall, our micro apartment report. As far as the agenda for today, first up, we're looking at a regional overview. Next up, we're going to cover sub-market insights for each of the sub-markets in our region. Next, taking a look at the near-term forecast, and we'll finish up with a more long-term forecast, what's occurring in the Puget Sound apartment market. So first up, regional overview. These are the 4 Western Washington counties. We have our research broken down in King County into 4 different geographic areas. And then now in Tacoma, we're covering urban Tacoma because we see some urbanization going on there. And in the regional overview, just want to give a couple of highlights of what we noticed in our research from a regional aspect, and then we'll dive into each submarket and talk about a couple of trends that we're seeing in each one of those submarkets. So first off, this is across the region, the 4 Western Washington counties. This is a 15-year graph covering historical rent and vacancy rates. So big picture is really strong rental rate growth. We, pretty much from the last recession, the Great Recession, we had really strong growth. You can see a dip in 2020. So across the region, we did not grow rents in 2020, but you can see that they have picked up in 2021. So at 1837, we're now past the previous peak. This is, previous peak was just a little over $1,800 a month in average rents across the region. So we've now surpassed that. Looking at vacancy rate, which is the other side of rental rate growth, vacancy rates, what this data includes is gross vacancy, which includes lease ups. So we're probably about 2% higher than you would normally see. So this is somewhere banded between 6 and 8%, whereas market vacancy has usually been somewhere between 4 and 6% across the market. Now, when we add in the amount of new development we've added to the market, we're pushing up those vacancy rates. But it stayed pretty much between this bandwidth even during COVID. Now we'll look at some of the submarkets that did not fare so well. But what's really poignant here is not only that we grew rents from 2020 to 2021, but where this vacancy rate dropped down to. So this is the lowest recorded vacancy rate in the last 15 years as of the last quarter of 2021, which is really terrific. So overall, it's really showing the Puget Sound apartment market is extremely healthy. We've got thumbs up in both rental rate growth as well as vacancy rates. And it really demonstrates the fact that we've remained a strong market despite some of the headwinds, quite a bit of headwinds we had over the last coming up on 24 months. I guess next month we're back into March, which is where we started COVID back in 2020. Now, taking a look at King County, just to dissect this data a little bit more, you can see rents really trailed off in 2020. They dropped quite a bit. The only reason why we had rental rate growth drop across the entire region is due to King County, and mostly because of Seattle and Bellevue. So you can see the drop that occurred, but what's really terrific is even in King County, which covers all of our urbanized markets, we've still been able to keep our rental rates recover from COVID, and now we're just a touch under $2,000 a month across King County for rental rates. Now, if you look at this again, as opposed to vacancy, rental rates have grown strong, and just in this last year from 2020, we've really pushed down vacancy really to a low in this market while we have grown rental rates. To me, that's the sign of extremely robust, healthy market. Again, 2 thumbs up there. Specifically, this is for King County. Now, taking a look at a completely different county, taking a look at Pierce County, and you look at the data here. Now, the bar, we've normalized these graphs so they're the same. So the bars are much lower, meaning overall rent is not nearly as high. But if you look at what's happened in Pierce County, is we've had strong rent growth since 2 or 3 years after the Great Recession, and that didn't really pick up until about 2016. So Pierce County got started a lot later, but if you look at the growth from 2016 through COVID, we had really strong rental rate growth during COVID in Pierce County, and even more growth coming into 2021. Now, if you look at vacancy rates, they really shot down from the Great Recession. We bounced around a little bit the last couple of years, and it was really occurring as we were building on rental rate growth. And that's something we'll talk a lot about in this presentation is how do you match up rental rate growth with vacancy rates? So we're showing Pierce County as opposed to King County because it was a laggard market for the last couple of years, but it really has outperformed in the last 24 months, and it has some of the lowest vacancy rates in the market. So when we're looking at the region as a whole, one of the things we really need to dice up is how each one of these individual markets is compared to the next, because the markets are really not acting in lockstep. Now, more recently, they're starting to do so, but there's been a lot of variation in the last 24 months. Now, looking at historic sales volume, this is a really good measure of how investors have reacted across the market. Now, looking back in 2019, that's when we had an excise change. We pushed a lot of sales. I'd say our previous peak in sales, you can see, is in 2016. Really, it was down in 2017, but we had the greatest number of sales and greatest sales volume in 2016. And we thought it was going to slow down towards the end of the decade, and the excise tax picked up. I think what's really shocking from our research, which we didn't expect as we were getting through 2021, especially as we entered 2021, is the fact that we'd almost hit the same amount of sales volume in dollars in 2021 as we did back in 2019. I don't think anyone would have bet that would have happened, but we nearly hit $8 billion of sales last year. And you'll see we're down quite a bit in the number of transactions because back in 2019, we were over 500 transactions. Now we're at 383 for last year. This is 5 units and up in the Quad County region. And what this really demonstrates is the great majority of transactions have been larger, more institutional sales. And a lot of that has been pent up demand from capital that was not placed in 2020. And you can see from this graph what an anemic year 2020 was compared to both 19 and 21, but also we really didn't have that low of a sales volume year since 2013 or 14. So it really trailed off from previous years. So looking back at 2021 from a sales volume perspective, absolutely incredible, really moved the needle much further than we thought it would. Now, I'm showing a thumbs down only because the actual volume of transactions did not compete to 2019. I don't think that was even the expectation coming into 2021. We'd have nearly that number of amount of sales, but really was an overall historic year as compared to historic sales. Now, the next graph is really interesting. And what we'll do is go back to 2017. And just as a quick descriptor, each one of these bars is one of the 4 different counties. And what this is demonstrating going back to 17, 18, and 19 is just how much is the difference from going from a core cap rate in King County to suburbs. In general, what we've seen is somewhere between 100 to 150 basis point spread. That's really demonstrated in 2019 with the excise tax up, really seeing urban cap rates push down. 2020, very similar to previous years, but what we experienced in 2021 really defines what happened last year from a sales perspective is just the fact that all cap rates got pushed down. Now, the urban cap rates probably got pushed down in 30 to 40 basis points, but what's really spectacular is you look at cap rates in Kitsap County, in Pierce counties that were up over a 6 in previous years are now in the low 4s. And this immense cap rate compression really defines what's occurring over all of the markets in the Puget Sound region. Now, it's occurring in different places for different reasons, and we have some theses of how that may change coming into 2022 and beyond. But this really punctuates how aggressive investors were in 2021 and how much of a banner year it was from a cap rate compression standpoint compared to the last couple of years, which were truly some of the most robust years in the history of the region for investor demand. So moving on to urban King County, we've got about 14 markets that we define as our urban markets, and essentially goes up from the Roosevelt neighborhood, somewhat to the bottom of Lake Washington, over to the west side of 405, out over to Magnolia and West Seattle. And these are our urban markets, and we've been tracking these markets diligently for the last 10 years. And I'd say the last couple of years has been one of the first times we've seen investors not as robust on urban King County. So looking at the data has been interesting. And the first insight we have here is just what happened to rental rates. And the real key here is we exceeded 2019. Now, we saw this across King County, but what's really impressive is this is just in these urban core markets that you see in the news. There's been anyone who's visited downtown Seattle and to some extent downtown Bellevue has seen the homelessness, the lack of open retail. It's been really tough. Now, what's fantastic about this is despite the dip we had in 2020, in 2021, we're back over $2,000 a month in average rent for our urban markets. I don't think that was expected. We'd rebound so quickly. That was not my prediction. My expectation we'd be in Q3 of this year before we'd see such a rebound. And on the flip side of that, from a vacancy rate, we went from a peak vacancy rate down to one of the lowest vacancy rates on record in the urban markets. Now, again, these are inflated just a touch because we have so much new development going on in the market. So this includes some of that new development, but it's really impressive the fact that going from 2020 to 2021, we've been able to grow urban rent so much and push down vacancy rate so much. I'd say the two aspects that really punctuate this is one is office demand. Currently, office buildings are probably no more than 30% occupied in downtown Seattle. A bit higher in Bellevue, but their market's about a quarter the size of Seattle. Albeit we have only a third of the office tenants back, apartment buildings are full and we're pushing rental rates, which is really spectacular. We've been able to do so in the urban core. Now, just looking at how this recovery occurred, if we look at last quarter, Q4, average rents were about 2,053, vacancy rate was about 6%. If we look at 90 days prior to that, which is the end of Q3, rental rates were actually higher and the vacancy was lower. So what does this mean? Well, we're back to seasonality, and we always have seasonality in the wintertime. Now, some of the other markets in the region push through seasonality, but in the urban core, we had grown rent so much, we receded a little bit. And what that tells me is we're going to have a nice spring surge ahead of us because we've retracted a little bit. Now, if you look back at Q4 of 2020, this is the real big picture of this massive recovery that we had in 2021, is the fact that 12 months prior to today, our rents were about 14% lower and our vacancy rate was a whopping 9.4%. So when you look at just from overall recovery, the fact we are where we are, especially to our cohort markets, and I'd say these days that's Chicago, Manhattan, San Francisco, the west side of LA, I'd say Seattle, somewhat the scourge of all those markets, Portland excluded, during the last 12 to 18 months, we've really recovered when it's come to the actual numbers. And I think we're really outperforming our competitive cohort nationally. And that's a really big story for the urban markets. And we'll touch on that a little bit more. And turning to sales, we're going back here to 2016. There's a lot of data here, but really what I want to punctuate here is peak pricing in 2019. That's where dollar volume may not have been as high, but across the region, but in the urban core, that's where we had the highest dollar volume, the most sales, and really, really strong pricing. Now you look at 2021, we're about on par, price per unit's down, price per square foot is down a little bit, but what's interesting is where the cap rates are. So we've pushed our cap rates down, and the expectation is if our cap rates stay down and we have continued NOI growth in the form of rental rates increasing, expect pricing to continue to push up in the urban environment. Now, the twin side of that is what's going to happen if interest rates rise. But what this really punctuates is, although we've had great sales, the pricing hasn't really exceeded where we were back in 2019. And this shows that compared to where we were on a price per unit on average of nearly 400,000 a unit and 464 a foot, here we in a 4.2 cap, here we are much lower in all of these metrics, which means there's some room in this market. Now, we've seen some remarkable sales records in the urban environment on the east side. So whether it's in Kirkland, whether it's in downtown Bellevue, and in the Spring District is actually on the other side of 405, so we're not counting those recent sales, but they've been spectacular sales on a price per square foot and price per unit basis with really low 3 cap and sub 3 cap numbers. If we continue to see the rental rate growth that we're seeing, we could see continuation of that price surging. So overall, the urban market has done spectacularly well. We have a lot of room to grow. We have a lot of work to do in the urban environments as well, especially in Seattle, but we're starting to see some good news about that. I think Microsoft opening up its campuses, having people come back to work. They were the first group to shut down during COVID, and it was starting as early as February, they were shutting down. I think they were the canary in the coal mine. On the flip side, that's going to signal with them opening back up to other tech employers, it's time for them to open back up. And based on that, I think we're going to see these dynamics continue to impress in our urban environments. Moving on next to North King. The North King market's been a very interesting market. Back in 2013 and 14, it was a little bit sleepy, but as Seattle and Bellevue picked up, North King started to pick up as well. So the first thing we're going to look at is just that effect going on again. You can see the rental rates here are now moved up from where they were. It was pretty flat, even in 18, 19, and 20. And part of that is Seattle rents didn't grow as much in those times because we were absorbing new product. We were delivering about 6,500 to 8,000 apartment units each year in the urban environments in those last couple of years, which meant rental rates had not pushed up. Well, now that rental rates are starting to come back in the core, it's pushing renters out of Seattle, out of Bellevue, into North King. And as a result, we're seeing really good rent appreciation in that market. And it's getting expensive again. And as you can see from this graph, vacancy rates have come down as well. So that's telling me there's a little bit of upward pressure on rents in North King. And as a result, there's some opportunities there, both from buying and pushing rents, but also we're seeing some opportunities on the development side in North King to actually do more development. You're starting to see that in markets like Lake City. You're starting to see it in markets like Northgate and pushing up further to Shoreline. And part of that is we're seeing good lifestyle opportunities in those markets as well. Now, moving on to our second insight going on in North King is large property sales volume really surged. In 2020, you can see the sales that we experienced in 2020, they were very small. Now, also in 2020, 0 buildings sold under 50 units. And in 2021, of those 15 sales, only 6 of those were buildings over 50 units. So the transaction volume in North King really is smaller apartment buildings. We're not seeing the sales surge that we saw in other markets. And part of that is we haven't seen pricing move. And to me, that says there's a really good opportunity in North King from an investment perspective, as well as from an ownership perspective of the ability to push rental rates, the ability to develop new product in those markets, and potentially acquire properties at a rate that may feel a little bit discounted to Seattle and Bellevue. It may seem expensive at the time based on current NOI, but our projection is that NOI is going to increase quite markedly in North King, like it did a couple of years back in the cycle. Moving on next to East King. East King has been one of the most watched markets, and a lot of that is we're looking at these markets just east of 405 and Woodinville on down to Redmond and Kirkland and east side of Bellevue. It's just been a popular market. Part of it is it's one of our few markets that is a more suburbanized market, but even though it's suburbanized, it has urban effects. And to me, our East King, if you're familiar with the Bay Area, is really our peninsula, taking you down through Silicon Valley. And I think if you're betting on the long term, East King is going to be one of the most bankable markets in the United States for the next 20 or 30 years. If one had invested in Silicon Valley back in the early 90s and early 2000s, I'd say similar dynamics that we're seeing in East King right now. Pricing is peaky, it's expensive as we're going to see, but I would say, having talked to a lot of investors that are more national, East King is probably one of the most investable markets in the entire West Coast. Now, taking a look at some of those dynamics, I think the first thing that's very clear from this graph is just absolute sales volume. So East King had $1.2 billion in transactions last year. Now compare that to 2019, it hadn't even hit $1 billion. And the only time East King had got even close was recording just over $500 million in 2012, a decade ago. So it's a remarkable surge, but if you look at the actual number of transactions, it's pretty comparable to the 10-year trend. What's happened is large buildings have been built, more institutional sales, and there has been a robust market both for merchant built buildings and long-term ownership to sell to a very fervent buyer pool that believes in the long-term dynamics. Now, another aspect at play is it was sort of a safe haven market during COVID. We've seen so much growth in the Bellevue market. I'd say there's probably about 7.5 million square feet of office underway in Bellevue, and about 95% of it's pre-leased. The overall pipeline there is over 10 million square feet, and it's probably somewhere north of 70% pre-leased. So there is huge speculation on what's going to happen in that market. I think it's warranted speculation because there's so much pre-leased space, and apartment investors have followed suit, and they realize these office buildings are going to produce tenants for their buildings as well. And as a result, we're seeing massive sales volume. Now, we don't have that many smaller buildings on the east side, and we'll take a look at some of those dynamics in a moment, but really we're seeing massive sales volume, and we'll next look at what that pricing equates to. And so if you look at pricing in 2021, we're back at this 3.8 cap, which is similar to the urban markets, which is surprising it's compressed that much. But if we look at price per unit and price per square foot, it's very comparable to otherwise urban markets, even though East King has not been that urban, but the product they're building is very similar. You look back to 2021 and you look back at 2019, our peak in values, very similar sales. So what we saw in a year post COVID 2020 is really a return back to the metrics that we saw in previous years, and even more robust investor demand in the form of low cap rates. Now, some of those cap rates are artificially low because they were on COVID rent rolls and NOI wasn't as high, but now we're starting to see those same cap rates on fully stabilized rent rolls and operations, which is saying that maybe our new 4 cap is a 3.5 on the east side, which is really remarkable seeing where the market has been overall. Now, the last aspect on the east side that I want to talk about is just balancing rental rates with occupancy. You can look at where rental rates have gone on the east side, looking back to 2018, even during COVID, they actually appreciated during COVID. Looking in just 90 days ago, they have receded a little bit, $25, so about 1% in the last 90 days. Again, that's some seasonality, but there has been massive rent growth on the east side, which is really spectacular. It's even more spectacular when you look at where vacancy rates are. Now, take some of these with a grain of salt, because we're realizing that this includes new construction. So we've probably got somewhere between 2%, maybe even 2.5% of noise in these numbers, and in certain markets upward of 3%. So some of these rates probably should be in the 4s and 5s on a stabilized basis, but we just had a lot of new product deliver on the east side. And if you look going forward to just 90 days ago, it's compressed down. So not only have we grown rents, we've compressed vacancy. And if you look in the last quarter, rents dropped a little bit, but vacancy dropped quite a bit. And what this shows me is the market's just hunting around for some form of equilibrium, and we're having a balancing act on the east side. Now, we need to balance this because we are adding a lot of units, but when you look at just the absolute rental rates, there's been a massive amount of rent appreciation, even just catching back. I mean, pre-COVID, we were still in the 1900s. We've gone way past pre-COVID. So I hate to say it, but Bellevue continues to steal Seattle's thunder. I'll have some comments on that at the end of why I wouldn't count Seattle out. But for right now, we see the investors have spoken. And from an operations perspective, it's good reason buildings are performing extremely well. Now, taking a quick look a little bit more granularly is if you look at the actual rent appreciation for 5 to 50 units in Bellevue, there has not been that much rent appreciation with smaller buildings. And overall, vacancy rates were lower in those buildings to begin with. They've gone even lower post-COVID, but I think there's a dislocation in the market. I think there's some opportunities for some gems, some smaller buildings in Bellevue that are not in all of East King, not just Bellevue, but that are not optimized. And I think the more institutional owners, the larger owners with professional managers have really captured the zeitgeist of Bellevue and the east side right now. But I think there's under-optimized assets where there's a very good investment play on the east side if you can find them and if the pricing is right. The smaller buildings we've seen come to market, many of them have been overpriced, but there are some gems out there. So I would say that the entire east side's been a very investable market. It's been difficult finding opportunities to make money, but I think they exist. And from a long-term perspective, many investors are just looking at the east side like a treasury note. Now, moving on from South King, year over year, quarter over quarter, as I prepare for these presentations and I look at our research, it's just clear that South King is one of the most consistently traded markets and consistently performing markets. And it's been that way for a number of years. And whether you're looking at rental rate growth, you're looking at low vacancy, high occupancy, or you're looking at sales, South King has remained extremely hot. So looking at this last year, what's happened there? Well, overall, we've had sustained rent growth. Now, again, compared to the urban environments, it was a little bit muted. We looked at Pierce County much earlier, and it took until about 2015 or 16 to pick up. It was about 2012 or 13 that we saw South King pick up. And most of that was people getting pushed out of Seattle, getting pushed out of Bellevue, first going to Renton, then going to Kent, then going south of there, trying to find affordability. And really through COVID, you can see that rent growth tapered off a little bit from its growth, but it did not go negative in 2020, but it's really picked up in this last year. And at that same time, you look at vacancy has really shot down. Now, any of you have listened to me before, I talk about graphs with perfect curves. These are the perfect curves you want to see. Strong rent appreciation, really good decline in vacancy rates for strong occupancy. And that's what we've seen in South King. Now, the question is, okay, those are great dynamics, even better than most markets. What happened to sales? Well, what's really interesting is sales massively declined. If you look at sales volume for the last several years, call it 2014 to 2019, and the red line is the number of transactions. In South King, we were looking at generally between 60 to 80 transactions every single year for that block of time. The most transactions of every market except for downtown urban markets. And if you take out the really small deals in the urban markets, South King outperformed those markets as well as far as a transaction volume. Well, it's not too surprising this slowed down in 2020, but what's interesting is it also slowed down in 2021. So the question is, why do we have somewhere between a third and half the number of sales going on in South King? And I think part of this is owners that own properties in South King knew they had really well-performing properties and they were not inclined to sell them. And many of them still are not inclined to sell them despite values going up markedly. And we'll talk about those values a little bit later, but it's been very impressive to see that a lot of owners have held on to their buildings in South King. And part of it is what are they going to replace them with? And also, I think there was a bit of a dislocation that not all owners had seen the compression in cap rates. And as a result, they were sitting on a lot of unseen value, which we're starting to see getting extracted out of the market. And what punctuates this is just looking at cap rates over time. And if you look at where we were mid-cycle, call it 2013 or 14, the transactions that occurred started that north of a 6 cap. We were up in the 7 cap. And year over year, you can see steadily cap rates have declined further and further. And now we're looking at a 4.25. Now, that's really impressive because, ultimately that is about what urban markets were, call it 2 or 3 years ago. So we've seen a massive compression in cap rates. And as a effect of that, we'll look at what's happened to pricing. Now, the top graph shows buildings 5 to 50 units. There's not a lot of trades, there hasn't been as much activity there. But if you look at the 50 units and above, the first thing we see is price per unit. We've seen 20% appreciation in price per unit. We've seen 40% appreciation in price per square foot. And part of that is we've seen cap rates compress nearly 70 basis points. So this is really the punctuation in this market of the sales that did happened at really strong pricing. We just have not seen the volume pick up. Now, the question becomes, as we get towards interest rates are edging along the 4s, are we going to see cap rates stay compressed in South King as much as we've seen the transactions push that way in recent months? The question is, will that hang on? And that is an open question. But overall, South King has performed extremely well. We've just had more metered sales volume and muted sales volume compared to what we expect relative to the other markets in the region. Now, moving north, taking a look at Snohomish County. Snohomish County has been one of those markets that generally reacts to some of the other markets. And what I mean by that is it's sort of the first to decline, the last to recover. And it's been interesting watching in COVID to see if that phenomenon has occurred. Now, looking at rental rate growth versus vacancy, what you'd expect if you look back at this graph in the Great Recession, the bars bounded in blue. In 2008 and 9, rent went down, vacancy went up. Now, looking forward, what happened during COVID is rental rates went up and vacancy went down, which is the opposite we'd expect in Snohomish County. A decade ago, that's not what happened there. But a lot of what we've seen is people push out of the urban core. People want more space. And that's been a little bit different than people receding from the outer edges and coming into the core when there's been a downturn and the core markets have gotten more expensive. We really had the opposite effect during COVID, and that's really punctuated with what you see here in this graph. And if you look at the actual surge that's occurred in the last year, it really shows that renters have got up to Snohomish County. They like Snohomish County and they're staying. And if you look at what's happened in vacancy, people have been loath to move. And it really has shown that it's been a banner year from a rent growth and vacancy perspective in Snohomish County, much more than we would have expected. Now, taking a look at the actual rent growth in small buildings versus large buildings, the top table shows 5 to 50 unit buildings. And I'll say this is part of an update to our research. So when you're going through our research report, we'll take a quick aside. It's pretty long. We're somewhere around 80 pages. We cover every single transaction that occurred last year. We break it down by building vintage, building age, and building location. But once you start to understand the dynamics, it's pretty easy to dissect each section. And here we're looking at smaller buildings versus larger buildings. And smaller buildings, we haven't really seen that much rent growth in Snohomish. 2019, we were a touch over 1,200 a month. And here we are, the end of 2021, we still haven't scratched 1,300 a month. Now, on the other side of that, vacancy has stayed low, so it makes sense. But if we look at 50 unit and above buildings, what you'll see here is we've had massive rent appreciation. We've gone from a touch under 1,600 to over 1,800 a month. Now, what's really fantastic is in that same time, we've actually compressed vacancy rates. So what it's showing is these larger, more professionally managed buildings are really capturing the momentum in the market and taking advantage of renters fleeing these otherwise urban markets that have been a bit disfavored. And they're even able to capture that rent growth and remain in the low single-digit vacancy rates, which really supports the fact that this market has stayed strong. Now, as we see some eviction moratoriums end, the question will be some of these renters that have stayed in these buildings that aren't paying rent, are they moved out and do rents drop a little bit? But for right now, Snohomish County has performed absolutely spectacular from a rent growth and a vacancy rate perspective. Now, looking at the other side of that coin, looking at pricing, what's been interesting to see is cap rates, pretty typical. If the urban markets were in the low fours, we had about 100 basis point spread getting out to Snohomish back in 2016 through 2020. We've actually seen these adjust down about 100 bips, which is consistent with what we've seen across the market. But what's interesting is this pricing movement. We were at 228 a unit in 19, a banner year for sales, and we're at 249 a unit right now, which is about 10% appreciation, nothing near what we've seen in South King, which is over 20%. And if you look at price per unit at 272 compared to 274 right now, what this is telling me right now is there is still pent-up opportunity there's pent-up sales, there's opportunity in pricing in Snohomish County if you can get your hands on assets up there. Now, the question will be, again, interest rates, how that impacts cap rates. But I feel very strongly that we're going to see good rent appreciation in the core as we get through this dip from COVID and march into the next economic cycle. And that, as it always has, is going to push renters outside of the core into markets like Snohomish. Well, the only difference is they started there. So I think they're going to be loath to move out from markets like Everett to Marysville because there's more going on in the core in some of these more urbanizing suburban markets like downtown Everett. So I think there's real opportunity in the north end that people have not really exposed yet. Next, we'll take a look at Pierce County back in the south. We talked a little bit about Pierce when we got started. Pierce has been a real winner during COVID. I think people had not expected it. I think there's been this talk about Tacoma being the next great market, and we've been waiting for that to happen for a number of years. Well, it's really taken hold. So first, we're going to look at what we call urban Tacoma, the downtown neighborhoods around downtown Tacoma, and just looking at sales volume. Now, it's been really fantastic. It matches what we saw in 2019. If you look at the actual number of transactions, it's not a huge number of transactions. This has been punctuated both in 19 and in 2021 by a couple of large transactions that got us over 100 million in sales volume. But what it shows is, most of these are new construction. Developers are going down to Tacoma. They're seeing opportunity. they're building buildings and selling them, and they're doing quite well. So it's worth noting that urban Tacoma has been a sleepy market. It's mostly been larger sales, but we're starting to track it because we're seeing real momentum in that market. We think this next cycle is the cycle where Tacoma is going to really hit, and we're seeing that in the early numbers. Now, taking a look at Pierce County in general, looking at rent growth has been very steady. As you can see here, it really didn't pick up until 2015 or 16. We talked about this a little bit earlier, but what I love about what's happening there is even though we've had this really strong rent appreciation, we're still under $1,500 a unit average rental rates. So what this tells me is there's still room to push rental rates in Pierce County, which is a lot of opportunity because there's not a lot of other places to go that you can find cheaper rent at this point. So I think Pierce County is really demonstrating that it's showing legs. And even though we've seen a big pop in rental rates, it really is pretty far away from the next suburban market where rents are around $1,700 a month. And at the same time, we've had fairly low vacancy. But if you look at this trend in the last 3 years, we've really pushed rents up and vacancy down. So this is telling me there's a lot of opportunity in Pierce County. It still exists. We've seen some appreciation, but we're not totally there of it being tapped out. Now, the next thing is just the huge amount of sales volume in the more suburban markets in Pierce. And if you look at the data here, you see, once again, we've matched what happened in 2016, our previous peak market outside of the excise tax year of 2019. The number of transactions have dropped down because we're looking at larger transactions, but this is showing the investment community, and arguably some of it that would otherwise be in South King is now moved to Pierce County. People, even though South King is a great market, some investors just don't like seeing King County on their tax bill. They'd rather get out of the county, and this is really being demonstrated by the volume of sales occurring in Pierce County. And taking a look at the impact of that, here are cap rates in the end of the previous cycle, pretty high cap rates, and here's the trend line. This is something we've seen in other markets. We saw this in South King. We're seeing it in Pierce County. It's more of a continuation going down. And as a result, we're looking at sub 5 caps in Pierce County. And I'd say on some of the rent rolls, they're quite a bit lower as well. Now, what's the real story here? Oh, we'll go back a slide, is in addition to that, I don't have noted down here, but if you just look at 2011, 10 years ago, we were looking at the average price per square foot was under $100 a square foot. And now the average price per square foot in transactions last year is $231. So a huge amount of actual real appreciation at the asset level. Next, moving on to Kitsap County. We're really loving Kitsap these days. It's becoming a sweetheart market. It seemed to live and die off of Bremerton in the years past. I think there's a whole new future for Kitsap. We're really seeing it in the numbers, and we're excited to present data on it. First off, a lot of data on this graph, but big picture on this graph is we're looking at rental rates. The yellow bar and the orange bar are older buildings. The blue bar is newer vintage buildings. Not as many newer vintage buildings, but what you can see here is rental rates are quite low. We talked about this a moment ago, and these are all with smaller buildings. So you look at the trend here, these are sub 50 unit buildings. We're now seeing vacancy rates at 2% in Kitsap County. Now, on the other side of this, we have not raised rental rates that much, but it's really showing that this market, there's an opportunity with smaller buildings to push rental rates and really get back to market equilibrium vacancy, which is probably somewhere around 4 or 5%, which means we could double those vacancy rates, probably push rents a good 10, 15, maybe even 20% in these smaller buildings. So it's our first insight on this market. Next, moving on is just larger buildings, 50 units and above. You take a look at where rents were, $1,471 in 2019. 2020, they moved up even during COVID. Q3, they were at their peak, $1,824. They've come down a little bit. And really what this is just, again, I mentioned this before, is trying to find that equilibrium. even at 5% vacancy, it's the middle of winter, not too bad. But looking back at that Q3 2021 last quarter and the vacancy rate at 3.8, we've seen older buildings that are more professionally managed really seize the opportunity in Kitsap County and take advantage of a huge amount of renter demand. And really, I don't see this renter demand as being temporary or transient. I think more people have discovered Kitsap County is a great place to live. More employers are moving over there. Yes, the base is doing well, but I think this is more of a long-term trend than something that's more structural than cyclical. And as a result, on the investment sales market, you look at cap rate compression. This is some of the greatest cap rate compression across the market. We peaked in 2014 at 10 cap deals. Not a lot of them happened, but I don't think there's been too many markets on the western side of Washington that have been double-digit cap rates in the last decade. And we've watched it march down, and cap rates are actually lower than Pierce County. So we've seen a really strong amount of demand. Investors have taken notice of Kitsap County, and as a result, we've seen really strong value appreciation, and that's really punctuated again. Looking back at 2011, values were, call it $70 a square foot. Now we're at $234. So almost a 3.5x increase in just absolute value on a price per square foot basis of assets in Kitsap. There's not a lot of buildings, but we're starting to see more development over there, more transaction volume over there. And frankly, I think there's a long-term trend, and whether it's retirees, whether it's parents of tech workers, I think that's one of the markets that's going to provide an affordable place to live for people that have a beachhead somewhere in Western Washington, which is really, if you look at markets like New York, San Francisco, Chicago, LA, you've got to get pretty far outside of those cities to find affordability. And really, you're just one fast ferry away in the Puget Sound. And I think that's the future of Kitsap. We're really excited about it. So that's it for our submarket insights. Moving on to just a couple of forecasts, what we see happening in the market. I'll start with first our near-term forecast, where we're focused, where we're advising clients to spend some time focusing. First off is the urban core. I really expect strong rent growth as employers return to work. We heard some good news from Microsoft. I mentioned that earlier. I think others are going to follow suit. Right now, just taking a look at our urban markets, whether it's Queen Anne, Capitol Hill, South Lake Union, all of these markets are back to full occupancy. Rental rates are pre-COVID levels, yet we've got about 30% occupancy in these buildings, but yet we have full occupancy in the apartment buildings. So if you have the stomach to invest in the core, I think a lot of people are going to regret 24 or 36 months from now not seizing these opportunities. I think the urban core is going to perform spectacularly. I think the west side of Bellevue, people see it already. I think Seattle, they don't realize what's coming. We had 250,000 workers in downtown Seattle pre-COVID. We still have about 200,000 to add. That's going to put a huge amount of upward pressure on rents, and we're going to see those rental rates. It's just simply supply and demand. The development pipeline has slowed down, so I don't think it's going to be able to catch up with that. Next is the suburbs. I think based upon this urban growth, the suburbs are going to continue their strong dynamics. Generally in market cycles, we see people pull in from the suburbs. They're in the urban core, then they push out. Well, they're already in the suburbs. I think we're going to see new people coming into this market. I think the suburbs are going to do fantastically well. I'm particularly a fan of the suburbs that have urban dynamics. I really love what's going on in Woodinville right now, what's going on in Kenmore, what's going on in Bothell, in the north end. Same thing is happening in the south end in markets like Kent. And I think those dynamics are going to continue. So I'm really robust on the suburbs, but I think now is a good time to seize that before we start to see this urban focus push renters out. Next, Seattle versus Bellevue. We talk about this all the time. Some finding it easy to count Seattle out. I don't think that should be the case. We're already starting to find investors that were not buying Seattle assets coming back and asking us questions about Seattle. These are investors that swore up and down they'd never look at Seattle again, and they're getting their faith restored in what's happening in this market. So I really see these as twin superpower cities. I think the best thing to happen to Seattle is Bellevue, and the best thing to happen to the region is Long Island City turning down Amazon. So I think we're going to become one of these twin superpower markets like San Francisco and Silicon Valley, or you look at Southern California having both the west side of LA and having downtown in the Inland Empire. We are one of these markets that is now going to be competing on a national basis and an international basis. Next, sellers. What I'm saying is get in while the getting is good. We're keeping an eye on interest rates. I think interest rates will have an impact on pricing. So if you're going to sell, it may be better to look at that in the near term versus the long term. New normal, I think it's too soon to tell. I think we're going to see oscillations in the market. Cap rates are extremely low. To think that we're going to be in a low 3 cap environment for a long period of time, I think that's probably missing the mark a little bit. I do think we're going to see some rent appreciation with people coming back into the core. I don't know how long that will last, but I do see just some momentum in these trends. But I think it's going to have a couple of oscillations till we're back to full employment in offices, which I do expect is going to happen inside of the next 12 months. Now, finally, a couple of long-term trends that we forecast. One is we're just back as a region. I think everyone was concerned about what was going to happen in the region based on Seattle. We were talking about employers just leaving the region, and they were going to Texas and they were going to Atlanta, and people were just leaving the region. I think that everyone's realizing the error of their ways. I think California is making a lot of mistakes, but that's been something on a 20 or 30-year trend. And California stayed an expensive market. I think the Pacific Northwest is back on everyone's radar. We're dealing with international investors coming back to this market, although they're having a little trouble leaving some of their home countries, Canada included. But we're starting to see that interest develop in these markets. And I think from a long-term perspective, we're not only back, we're stronger than we've ever been. And part of that is just the rise of Bellevue as a national investment market. And I don't think that's at the deficit of Seattle. I think that's to the benefit of Seattle and the region as a whole. Next is urban dead. We talked about that a little bit. I think people are going to be shocked by 2024 that we even consider that urban was dead. What we're talking to a lot of clients about is if they want to be prescient, if they want to make good investments, look back in 1992. Everyone was worried in 1992 and they didn't want to buy. And those that were owning in 1995, 96, wish they bought everything in 1992. In 2002, investors were scared because of the dot-com bubble. And by 2005, they were ebullient. Anyone who bought was ecstatic that they bought when they did. Fast forward another decade to 2012, people were concerned about the market. Everyone who bought in 2012 was feeling very bullish. Everyone who waited in 2015 was lamenting why they didn't buy in 2012. Here we are 10 years forward in 2022, and I'm calling out by 2024, 2025, people are going to really lament the buys they did not make now, especially in the urban core in Seattle, because the pricing is not caught up yet. I think those are the best buys. Bellevue is terrific, but we're seeing some T-bills there. The neighboring markets, I think, are terrific investments. That whole ring from Edmonds, Mill Creek. I'm loving Issaquah right now, what's happening in the Highlands, Snohomish, all those markets are urbanizing rapidly. I think they're great long-term investments. Everything else is getting somewhat commoditized, but having that long-term outlook of how this market's going to grow is really key. The new suburban, I mentioned that just a moment ago. We wondered where millennials would move. They're moving to urbanized markets, and they're moving there sooner because COVID hit, and they had to make some choices or decide to make some choices where they wanted to land. And that's why we're seeing rents in Issaquah just do terrific. Rents in Woodinville do really well. These are urbanites that probably weren't planning on leaving the city for 4, 5, 6 years. COVID happened. They made those decisions. They moved to these markets, and now they're in those markets. I think the east side markets like Bellevue are becoming untouchable. Same with Juanita and Kirkland. So we're seeing other east side markets and north end markets. That's where the millennials are going. And that whole crescent, Edmonds over all the way out to Woodinville and Issaquah, is going to do fantastic in the long run. And is this a new normal, what we're dealing with right now? I'll say yes and no. Politics are getting better. We all know that revolves back and forth and it teeter-totters. I think the social issues are here to stay. We're an urbanized market. We've always been an urbanized market, but I think that's nothing new. I just think it's going to be grittier in our downtowns, and we've seen that in other markets. but I do think the political landscape's changing. We're getting more people caring about their city, and they're a little bit less transient in their thinking. Want to again thank our entire team. Want to thank everyone in our office for helping us put this together. All 6 brokers you see on here can help you out. We have various specialties, but want to help you with all your investment needs or questions about the market. You can look at our listings on our listings page right now. We're very active. We're excited to have all of you on the call. We've got a couple minutes left. I'm going to look at a couple of questions if I can figure out how to look at this. Can we get the slide deck? That will be distributed on Friday. Do you see outmigration from core to be permanent or reversing? That was from earlier in the presentation. I think I answered that. What interest rate do you see by the end of 2022? I think I'll go to Vegas and bet red or black on that one. I will say the interest rate will be higher. But the impact on investments, I say more core, it's going to be less impactful. But the closer you are of a stabilized yield to your interest rate, the harder it's going to be to not have cap rates rise. All right, well, we've got a couple of minutes left and we're out of questions on the Q&A. I'm sure not all of them got answered, but want to make sure I get you guys off to your next meeting as we're coming up on the next hour. So just a quick recap, we'll be putting out research reports on a quarterly basis. We'll be doing investor presentations. Some will be via Zoom, others will be private client events that we host for our clients. Would love to get to know each of you better. I want to thank everyone for your time. And I'm going to sign off now and wish you guys a great start to the spring. And we're excited to have more of you interface with us. Thank you so much. Have a great day.